Imagine owning a portfolio that generates enough dividends every single month to cover your bills, giving you the freedom to spend your time however you want. For many investors, this is the ultimate goal, to leave their jobs and live purely off of their portfolio. But how do you actually achieve this? I've spent years researching and investing in dividend stocks, and in this video, I'll walk you through the biggest mistakes new dividend investors make, how to spot opportunities for dividend growth, and how to build your own dividend growth portfolio. Alright. So you're ready to build your first ever dividend portfolio and start generating some passive income. We call it passive because you have to do the upfront work in purchasing the stock, but after that you just have dividends rolling into your account. So where do you start? Since we're aiming to generate passive income, we'll look for stocks or ETFs that pay dividends. You can spot these by checking the stock's yield percentage, which shows the annual return on your investment from the dividends alone. When you start looking at options, you might be drawn to the companies that pay the highest yields, thinking that they'll provide the largest dividends. But this would be your first mistake. Let me explain why. Companies with high dividend yields often aren't sustainable and usually don't offer much growth potential. This means that high yield you see today might not last, and the company may struggle to increase dividends over time. For example, let's compare Verizon, a high yield stock, with Visa, a low yield stock. Back in March 2008, Visa came onto the market with only a yield of 0.2%, while Verizon offered a much higher 5.6%. But over the next 12 years, Visa steadily grew its dividends, reaching a new yield on cost of 12%, while Verizon's yield on cost reached only 7.8%. This illustrates why a lower initial yield with growth potential can outperform a high starting yield in the long run. Now, what is the yield on cost? Yield on cost is calculated by dividing your current annual dividend income by your initial purchase price. If we look back at 2008, Visa's dividend would have paid you only 10 cents per share. But after 15 years of growing their dividends, this would have grown into $2.08 per share, representing your 12.8% yield on cost, demonstrating the benefits of companies with consistent dividend growth. Chasing high dividend yield companies from the start can be a risky game, considering that an opportunity like Visa all started from only a 0.2% yield. It's more valuable to find companies with strong potential for dividend growth. Now, how can you start building a portfolio filled with these very strong growth companies? Dividend investors usually look for companies with a track record of increasing their earnings year over year. Earnings are what support dividend payments, so consistent growth is a good sign that a company can keep raising its dividends. Companies with strong earning growth tend to be in sectors with predictable cash flows, like technology or consumer goods. Sustainable payout ratios are the next thing you may want to look out for. This is the percentage of a company's earnings that's paid out as the dividend. A payout ratio under 60% is sometimes seen as a more sustainable one, as it means the company is reinvesting enough profits back into the business. High payout ratios over 80% could indicate that the company might struggle to keep increasing the dividend if earnings slow down. Companies with a long history of increasing dividends often signal stable growth and strong financials. Check if a company has a record of raising dividends for many consecutive years. Think of some big names like Visa, MasterCard, Microsoft. All of these companies have followed this pattern. This is a strong indicator of the management's commitment to returning value back to the shareholders through dividends. Let's look at another example with Microsoft. If you had bought shares a decade ago, you would have seen substantial dividend growth over time. In 2013, Microsoft paid an annual dividend of 23 cents per share. This worked out to be about a 3% yield. Throughout the years, they have steadily increased the dividend amount. Now in 2023, the dividend is up to 68 cents per share. They've rewarded these long-term investors with a much higher yield on cost. Microsoft has consistently grown its earnings and maintained a payout ratio below 30%. They also have a strong track record of increasing dividends over the last 10 years. So by focusing on companies with these growth factors, you can build a portfolio that not only generates income, but grows it over time, enhancing your yield on cost and total returns in the long run. If you want to build the portfolio with just individual stocks, it's generally a good idea to diversify across different sectors to spread out your risk. You could also consider dividend growth ETFs or exchange traded funds. Think of these as baskets of stocks. When you buy a single share of an ETF, you're essentially gaining fractional ownership of a variety of companies, offering built-in diversification. There's plenty of dividend-focused ETFs available, but some of the more popular ones among dividend investors are SCHD and VYM. One of the reasons investors investors love SCHD is that they don't have to chase down individual companies themselves. The ETF's management team takes care of adding and removing these stocks based on their performance, so you could almost put this whole process on autopilot. Specifically, SCHD follows growth parameters that we outlined earlier, focusing on companies with a solid track record of dividend growth. You can see consistent payouts and dividend increases over time. Since SCHD is an ETF that holds hundreds of stocks, it doesn't have a single earnings per share or payout ratio like the individual companies we looked at. However, it's popular because of its focus on dividend growth, and it gives investors access to a diversified group of 100 dividend-paying companies in one go. These ETFs will let you see the holdings and a sector breakdown before purchasing them. With SCHD, we can see top holdings are in the financial sector, healthcare, consumer staples, and so on. Let's look at another popular ETF in VYM. This is another favorite among dividend investors. Similar to SCHD, VYM has a strong history of dividends and consistent increases, which is exactly what we want to look for. One of the key benefits of this ETF is that it holds over 500 stocks, which helps spread out your money across the market. The holdings of VYM are quite similar to SCHD, but with many more companies involved. It reduces risk and helps minimize the overall volatility of the fund. The last thing I want to touch on in this video is the power of DRIP, which stands for Dividend Reinvestment Plans. This option allows investors to automatically reinvest the dividends they receive back into the same fund or stock, increasing the number of shares you hold. This is crucial because it leverages the power of compound interest, where the dividends you earn will generate more dividends over time. If you want to snowball your portfolio into a dividend generating machine, using DRIP can be a highly effective strategy for long-term growth. Regardless of which option you chose, there will be risk involved in investing. It's important to remember that past performance doesn't guarantee future results. Make sure to research thoroughly and consider your own financial situation before making any decisions. This way, you can make choices that are most suitable for your own goals and risk tolerance. I hope you found this video insightful and now have a better understanding of the fundamentals of yield and how to identify opportunities with high growth potential. There are countless stocks and ETFs out there waiting to be discovered, so keep exploring and learning as you build your portfolio. If you made it this far in the video, be sure to like, comment, and subscribe for more financial education related content.